Hey, excellent. All right, let's kick this thing off. All right, so today, my name is Kyle, and I'm the head of marketing here at Notional Finance. And today we're here with Nathan Allman of Ondo Finance and Notional CEO Teddy Woodward. And yeah, so we're just gonna do another episode of our Notable Builders podcast where we just like to talk to other protocols, find out exactly what's going on, what they're building, what they're up to, talk about a little bit about the history of the protocol and where you're going. So, yeah, Nathan, why don't you tell us just a little bit about yourself and how you got into crypto?
Yeah, for sure. And thanks for having me as well. It's great to chat with your community. So I started my career in kind of TradFi, if you will, as in private credit investing at a firm that lends to U.S. middle market companies based in New York, and worked there for a couple of years out of college. Started really delving into crypto late 2016, early 2017. And so, invested and traded pretty actively throughout the last cycle. Got excited by some really early DeFi, MakerDAO, probably most prominently at the time. Ended up leaving Prospect at end of 2017, kind of around the market top to, trade and invest full time throughout 2018, 2019. And I guess fast forward a bit, mid 2019, joined Goldman Sachs on the digital assets team, helping them with really everything crypto and blockchain related. At the time, there wasn't a ton of institutional crypto market interest. And so we worked on security token issuances. Representing ownership on chain and, automating lifecycle events with smart contracts. And then, come mid 2020, when crypto markets heated up, got to be pretty focused on building out a kind of institutional crypto prime brokerage operation. Yields were kind of blowing up in the space, and we got a lot of questions about how to tap into them, both directly and indirectly. At the same time, I became a pretty active participant in DeFi, and was really broadly looking for some way to hedge out some of the underlying risks from DeFi, and eventually landed on this idea of building these structured products that pool liquidity from across the ecosystem, and then disaggregate it into tranches with different levels of risk. And that's kind of how I came to start Ondo a little over a year ago.
All right, cool. Yeah, that makes sense. So you talk a little bit about what Ondo is doing now, I guess. So what do you see that the problem exactly that Ondo is solving now?
Yeah, I mean, today, we really consider ourselves kind of a decentralized investment bank. So, what that means is, like a traditional investment bank, we are, broadly connecting capital supply and capital demand. So, investors, both, retail and institutional, increasingly so the latter over time, with, various yield and investment opportunities in DeFi, largely that are originated by DAOs, or that we help DAOs originate, such as debt capital raises in order to, market make a DAO's own token. And I guess, unlike a traditional investment bank, we, provision those services in a, DeFi native way, where, the contracts execute autonomously on chain, and, where the services are geared towards largely crypto native market participants. Um, we didn't really start with this broad mission, I would say. Like, we started as kind of structured products for DeFi, which is a segment of what we do today. And in the structured products space, we're kind of solving for the volatility and underlying risks of yield and DeFi, and making those more accessible to more risk averse institutional investors through the use of risk tranching.
Okay, okay, makes sense. So So you do a bit of risk crunching and you offer on the structured product side a fixed rate. So there's some overlap kind of with what we do. Is that in the sense that it's fixed? Is that right? And what do the yields look like there?
Yeah, I mean, broad similarities in that there are fixed rates. I guess pretty different in that we are, at least with our products right now, we're aggregating yield from largely existing liquidity pools, or I guess in the context of liquidity as a service, new liquidity pools. But yeah, really focused right now on yield from automated market makers, and where the fixed rate or the fixed tranche is getting protection from impermanent loss. In terms of what the yields are, I mean, it's very asset and market dependent, and obviously all of DeFi yields have come down pretty precipitously lately. But generally speaking, the fixed tranche rates are a little bit lower than what the market yield of the underlying assets would be, because they're getting some protection of decline in rates or blow up of the underlying assets. And then conversely, the variable tranche or the junior tranche rates are higher than the market rates of the underlying assets, as they're getting leverage on that pool.
Hey Nathan, so thanks for joining us today. So I've got some questions for you. So I think that what you said so far, sounds really interesting, and I think that what can help people understand uh, you know better what you're doing is through the use of kind of tangible examples. So I think it might actually be worth just first of all talking about what you do today, the liquidity as a service. I mean, I'm aware of that, but maybe some people aren't. And then also, like, if you like, what do you want to do in the future? Yeah.
Yeah, so I guess I'll talk about liquidity as a service first. So it's really an application of our structured products whereby we, help typically a stablecoin issuer provide liquidity into a decentralized exchange, into that kind of senior tranche, without taking on risk from IL. So I guess an example workflow here would be Fay or Frax or Maker could provide their respective stablecoins into a fixed tranche, and then a DAO that wants liquidity on decentralized exchanges so that its users can buy and sell its token with minimal slippage, and there's less volatility around its token, et cetera, will supply its native governance treasury asset into the variable tranche, meaning it takes on the vast majority of risk of IL. And then our contracts will combine those two assets together and then provide them, as liquidity to Uniswap or SushiSwap or Curve. And then, after some pre-agreed upon amount of time, our contracts will withdraw that liquidity, make sure the stablecoin issuers paid back their principal and a small predetermined yield, and then the DAO and the variable tranche gets back whatever is left. And so, it's one of now a few ways for a DAO to get DEX liquidity without resorting to, sort of more historical practices like pool to liquidity mining, which are, pretty dilutive. And, really that's just a form of like DEX market making, and, can also be used in kind of a direct listing capacity, as, we've talked about before, whereby, a DAO could establish its initial liquidity pool on a DEX through this means, and, not have to initially deal with, centralized market makers or, exchange listings with sexes, or again, pool to liquidity mining. In terms of how that fits into the bigger picture, like I think it's, one of many examples of ways in which we can, facilitate the creation of new investment opportunities that are kind of unique to our ecosystem. Like a lot of what we do is just, bundling and aggregating liquidity pools or other sources of yield, could be, CFI yields like, loans to Genesis and so on, into vaults and then sort of decomposing them. But, where there's a bit more alpha, I guess, is in the realm where we can, in typically like a service-oriented capacity, create some new investment opportunity, like investment banks do for corporates and for governments that, then they match make to, some source of capital supply. And so I think LAS is kind of an early example of that.
Okay. And so, I guess what I'm curious, or something I'm curious about is, like, what do you consider to be your principal value add, or like what do you spend the most time on? Is it like writing the smart contracts that codify these investment opportunities, or is it more on the business development side? Like building relationships with DAOs and stablecoin issuers and things like that.
Lately, it's definitely more so the latter. I mean, there's a lot of education that goes into liquidity as a service, especially with respect to DAOs, and it's a product that we've, for that reason, generally not made accessible to the community to go into the fixed tranche. And I think kind of for the foreseeable future, we'll keep it that way. Like we will either, with our stablecoin partners or, ourselves pretty soon, just provide that capital into the fixed tranche, and then, provide sort of more abstracted means through which retail can indirectly fund that operation. I mean, longer term, I think a lot of the work is really in making products that are both, investable on-chain and off-chain, and that bundle sources of yield that are on-chain and off-chain, and, really do all of that together, which, hasn't really been done yet in DeFi. Like there's, kind of Maple, TrueFi, Centrifuge, like the kind of off-chain asset tokenizers, and then there's some protocols that kind of seek to deploy into them, like Maker, but you can't really get like a diversified pool of DeFi and CeFi yields with risk tranching today. So, I mean, a lot of the work that is more long-term oriented is going into building the infrastructure to facilitate that.
Okay, that's interesting. And I guess I'm curious. Like, so the on-chain, off-chain. Is there any way that you could give me an example of like what you're thinking of? Because I'm just, yeah, I'm curious to like, like I'm curious to see, or like to understand like what you're thinking of here, and like what kind of like the the need you think you're servicing. Is it like is it like there are customers that you want to serve that are only willing to do something off chain, and you're sort of providing a connection piece between like people that are on chain and people that are off chain, or like I just, yeah, I don't know if you could give any example there, but like that would be helpful, for me.
Yeah, I mean, there's a bunch of angles here, but I mean, probably the simplest to dissect is just the investment product angle, right? So, if you look at the evolution of our vaults, like we started off, with 2 tranches on a single asset, so a single liquidity pool, and then pretty soon we're about to launch these vaults that are on, diversified baskets of liquidity pools. So like, various different curve liquidity pools, let's say. So, if even one blows up, completely goes to zero, then, the fixed tranche is still fine. That sort of starts to demonstrate why, in structured products that are built on baskets of collateral, like you want really diversification, and ideally diversification of assets that are not, super highly correlated to each other, to, better manage risk. And then, once you start putting in assets from CeFi, then you really start to get, better benefits to diversification. So like, probably the simplest example there would just be a vault, with 2 tranches, just like our vaults are today, but where the collateral is some combination of curve liquidity pools and, loans to Genesis, Alameda, BlockFi, et cetera.
I see. So in this particular example, you like somebody would put in some USDC, and then you'd take that USDC and you'd put some of it in a curve pool, put some in a different curve pool, you'd lend some to Alameda, and then you'd create this like basket like exposure. Is that correct? Am I getting that correctly or no?
Yeah, that's definitely one example of something we're working on in the space. And then, that's sort of half of what I touched on before with respect to, making CeFi and DeFi assets investable through our products. And then, the other is making the products themselves investable on chain and off chain. Like right now, everything's been very DeFi native. So you've had to come to our protocol on chain to invest. But certainly a lot of market participants, especially more institutional ones, or even more mainstream, like less crypto native retail, need various forms of abstraction, that don't involve them, self-custodying their assets in a MetaMask wallet to invest. So, that'll help sort of expand the capital supply of our products by making them investable off chain. But yeah, I mean, it's, I think, one of the challenges with our early products has been, the coordination of investors with very different risk preferences into our vaults, like at the same time, right? Like fixed and variable tranche investors coming together to, invest in some asset or some pool together. And so, it's pretty important that we plug into, diverse channels in order to, find participants in, all these different tranches.
Okay, cool, man. Yeah, that's really interesting. I'm excited to see. I guess I'm excited to see that launch. I think that's a cool product, and it's something that people haven't really done before. I guess there's because there's kind of like there's kind of like a Yearn, right, which is sort of like a pure DeFi aggregator, but there isn't something that like is half Yearn or half kind of DeFi strategies, and half CeFi stuff like lending to Alameda or Genesis or something like that. So I think that's like a new sort of basket of exposure. Cool. And I guess the idea then would be that well, there's this fixed tranche and this variable tranche, and they have different risk profiles, and so you would market them to different people, right? Is that then that's sort of like, I suppose, your whole business, right? Well, not your whole business, but you feel like you have a bunch of relationships and people want different things, and who to fill what gap. Is that right? Or who to put in which slot?
Yeah, that's right. I'd also emphasize it's not a binary choice, right? I mean, you could go some in one tranche and some in the other, and just kind of dial up or down your risk, proportionately. But yeah, I mean, I think the thesis behind multi-tranche structured products broadly, even in TradFi, is that you can lower the cost of capital for whoever wants the equity exposure, like whoever wants to actually own the asset by by getting financing at different levels of seniority from market participants with different risk appetites.
Cool. Sounds good, man.
Do you have, just like, that kind of goes into my next question, was, do you have like a user profile of who's using the fixed, lower risk tranches versus the higher risk variable ones?
Yeah, so early on, I mean, the fixed tranches would sell out pretty quickly to a few pretty like on top of it whales, if you will, and the variable tranches would kind of trickle in a little more slowly with retail. I think that's because our early products were on non-correlated LPs, where there's only one LP in the underlying, and the variable tranche asset would be like the longer tail asset, like the ALCX or YGG or something like that, that's just like not as widely held. And so, there wasn't quite as much appetite there. Looking forward, I think most of our products are going to be like dollar denominated, hence kind of the focus on curve pools and CFI loans, or Bitcoin or ETH denominated, where, in both the fixed and variable tranches. And so I think that'll change the user profile a little bit. I guess more lately, we've been pretty focused on liquidity as a service, where the variable tranche participants are exclusively DAOs, and the fixed tranche participants are really, they're like underwriters. They're these stablecoin issuers. So it depends a lot on the use case.
Okay. Yeah, that makes sense. That makes sense. So I did see the news that you guys did a 20 million Series A, if I'm not mistaken. So congrats on that pretty recently. What do you, I guess going along with that, like what do you see as kind of your challenges moving forward with, moving into areas of DeFi investment banking and launching these new products? Like what do you see as some of the main hurdles you've got to get over?
Yeah, our biggest struggle so far has really been the user education, and then the frankly like pretty poor user experience around having these really narrow subscription windows and having to reject a bunch of capital that comes in on the side that's oversubscribed. Really these are just forms of the problem of coordinating these investors in different tranches at the same time. And so far we've really been an agent. Like we've put these products together and haven't like taken any like balance be like principles in this marketplace. So we're working on a product where we'll kind of indirectly raise some capital, and then with the balance sheet that we raise, like we will invest kind of flexibly into the tranche that is like relatively underfilled, certainly up to certain risk limits, and help provide like a better user experience that way, and higher probability of acceptance of subscription requests, and should make the products a little bit stickier and the user experience a bit better. And ultimately that's how we'll monetize, by investing our balance sheet in that way.
Nice. Okay. And I guess like what are your success KPIs for Ondo, like in the medium to long term? Is it, I assume it's not TVL, it's like usage and your vault subscriptions being full or whatever. So what do you see as the that you'll know that Ondo's been a success?
Yeah, TVL is not a bad one in the medium term, especially if it's like caveated to be TVL that's sort of invested in vaults, like at risk, unincentivized, and so on. But certainly other usage metrics like number of DAO partners and size of those vaults, and I guess the more telling KPIs longer term are more like performance oriented metrics. So like churn of those DAO partners, default rates of our underwriting efforts, return on equity of the balance sheet. I think these things will really paint a more clear picture on how sticky or not the product is. Obviously there's a lot of sort of metrics of input that we pay attention to get there, like number of kind of off-chain integrations with retail aggregators or institutional investors, who we're kind of working on onboarding into the products, and just kind of checking these functional requirements of making Ondo vaults investable on-chain and off-chain, and bundling these on-chain and off-chain assets, which we don't really do today.
Okay, I have another question for you, Nathan. So, I guess what goes into your selection process? So, like I guess question comes to mind: why Curve? Why not Aave? And then on the other side, like how do you pick the centralized people that you're sort of willing to lend to? Yeah.
Yeah, I mean, we have a credit team that we're building out for the CFI lending aspect. So they're kind of responsible for that. I mean, in terms of Aave curve convex, I mean, the yields historically have just been a lot higher and, still reasonably scalable on curve convex. And, we've been working with all these stablecoin issuers who, are willing to provide incentives to, increase the reach of their stablecoins. So, and then there's also, I think, more material risks that warrant tranching on curve convex. I think there's been a lot of like risk tranching protocols that have built on Aave or Compound, but haven't really seen a lot of. They've kind of had the opposite problem that we've had. They've had like no demand for the senior tranches because people view Aave and Compound as already very low risk. I mean, Aave already has a basically a junior tranche, like the Aave protection module. So I just don't think that there would be a ton of senior tranche demand there, but certainly could, if the yields improve. I mean, if they're just turned off their incentives, but if the yields improve, could look to aggregate some of those yields into the vaults as well.
Okay, so I like because I'm just asking because like a lot of the curve convex yields have really come like quite far down, and I guess at least when you're looking at the the biggest three stable, like USDC, DAI, USDT, and so are you sort of like getting into the kind of the more are you anticipating this like launching these products where people are getting exposure to stable coins like Fei and Frax? Is that kind of your is that your idea of like where you're going to get this yield from?
Yeah, that's the intent. But the fixed tranche would have blow up protection from these stable coins, which is really why this is our first use case of like multi LP vaults. Because risk with these stable coins is, I don't know, it's a little more binary than like price risk of ALCX on Sushi Swap. And so if one of the stable coins were to blow up and we only had a single LP in the vault, then even the fixed tranche would take principal loss. So I guess what you'd have to believe to invest in the fixed tranche is that all of the stable coins are not going to blow up at the exact same time. They could all blow up eventually, but if they were to do so, sequentially, then the fixed tranche would generally be okay.
Okay. So maybe it's like you're investing. You got some in. So if it's like if you do like 50-50 on the fixed and variable, and let's say you invest and you put the capital in three sort of Fei, Frax, and some other one that's like on the riskier side, then the idea is that if one of the three blows up, then then the fixed tranche is still safe because it's like 1/3 of the capital is gone, and that gets pushed onto the junior tranche. Is that the base? Is that kind of the basic idea? The way that you feel that you can offer the senior tranche something suitably safe. Is that yeah?
Yeah, that's correct. In the example you gave, we're also going to start playing around with different different ratios of the sizes of the tranches, which we can finally do in this case because both tranches or all of the tranches are dollar denominated, unlike the vaults we put up on Uni or Sushi where each tranche is providing one of the two assets behind the 50-50 liquidity pool. So to use your example, if the fixed tranche were providing 33% of the capital, or effectively a 33% LTV loan against the underlying liquidity pools, then two of the underlying liquidity pools could completely blow up.
Right. Oh, cool. Okay.
And then,
so what do you? I mean,
Oh, sorry. I was just going to add on to that, like, in terms of demand on the variable tranche side, I mean, there's already billions of dollars of LPs in these pools who are already taking on this pretty binary blow up risk. So, for them to go into the variable tranche, like they're going to get, leverage on that. So they'll get, higher yields than they're already getting in these convex LPs.
Right. Okay. And so I know it's obviously like the market conditions change and all this stuff. But I'm curious, like what kind of returns do you think you can offer? Like just like on a ballpark, to the senior or the variable tranche.
We're trying to target, in these market conditions, something like, 6-7%. Maybe we'll provide a little bit of incentives if, yields stay so low. Bundling in some CFI yields will actually help here, as things have almost flipped.
Yeah.
But yeah, to your point, cool. These convex yields have come down a lot.
Right. Okay. Well, that's really cool, man. Yeah.
Yeah, the next frontier is really making CFI yields investable to DeFi investors. I don't think that'll hold for too long, but I view it as kind of a very needed solution to be able to toggle one way or the other based on market conditions.
All right, I was just gonna say we can open it up and just as quickly see if there's anybody in the audience that wants to ask a question. Feel free to raise your hand and we'll get you in. If not, then as I mentioned earlier, there's a tiny bit of overlap in the sense you guys do some fixed rate products in a sense, and we obviously at Notional are the fixed rate money market. So I don't know if you guys want to talk briefly about maybe Nathan, where you see fixed rates and DeFi going in the near term. If you have any predictions, or you guys want to comment on that, just to give people a little idea of maybe what you guys predict the near term holds with all this market turmoil.
Yeah, I think in DeFi today, like we don't have the traditional market participants that really want fixed rates. I think that's going to undoubtedly change, but we don't have like corporates like hedging underlying exposures or anything like that. So it's going to take a bit, but I think we'll get there. I don't know. What do you think, Teddy?
Yeah, I think that's fair. I think that people do. I think the DAOs are sort of like the emerging, sort of natural users here for fixed rates, in the sense that they're kind of like corporates. They're like DeFi's version of corporates, right? In that at least from our conversations, some of them are sort of like more structured like hedge funds, and then a lot of them are there's a core mission of the DAO, and the treasury is more set up to support that core mission, and we've seen like DAOs that are set up more like that are generally just more interested in stability and don't want to take risk really with their funds. They want to earn sort of a safe and stable return, because their core mission isn't optimizing that, right? So I think I think that DAOs are kind of an emerging consumer of these sort of fixed rate products, at least from the lending side. And then I guess on the borrowing side, I think we've seen at least at Notional, I think the primary sort of demand for fixed rate borrowing so far has been from more centralized companies. So people that are active in the the CFI lending space, at least from what we've seen Notional so far. Now I think that that'll change over time, but I would agree that, it's sort of like there's a level of sort of market maturity that isn't really there yet in DeFi. So I think it'll just take time to kind of develop.
Yeah, I think there's a much more obvious demand for downside protection of which sort of comes with a lot of these fixed rate or kind of fixed tranche products, including ours. But for now, can probably flex a lot of the sort of hard assumptions around the rate being completely fixed and deliver something similar, like a less volatile but downside protected return exposure. It's just very expensive in a lot of cases where the underlying assets are super volatile to offer a fixed rate.
Right. Well, right. So, maybe to kind of close it out here, Nathan, I guess, just what do you, what do you think about the market generally? Like, do you think we're in for a long period of low returns in DeFi, or where do you think, what's your view, if you have one, on where DeFi interest rates are going to go?
Yeah, I mean, DeFi interest rates are 95% liquidity mining, so they're really not. I guess I'll say DeFi quote unquote yield, a little more broad than interest rates, assuming that's what you're asking about. So it's more so what are the prices of these underlying tokens than any like true yield. I'm pretty bearish liquidity mining really long term, and so I do think that DeFi yields. I mean, especially as institutional investors increasingly build the plumbing to connect to this ecosystem, will converge with CeFi yields, and we're certainly seeing that on the more blue chip like DeFi repo platforms, if you will, like Aave and Compound, kind of looking like treasury yields right now. But where DeFi yields don't have whatever the intermediaries cut is. So in Aave and Compound, it would be where retail can actually get the stock borrows on their assets that they're getting leverage on.
Right.
So yeah, I mean, I don't think that, and I guess this is part of why we're focused on aggregating both DeFi and CeFi yields, but I don't think there's like enormous like structural differences behind like what the rates will be. I just think that the infrastructure is going to be a bit cheaper to operate. So yeah. So yeah, I guess to answer your question more directly, I mean, it really depends on what prices do, and that's just going to be driven by what global macro does. If we have a U or V shaped recovery, and yeah, TBT on that.
Yeah, for sure. I think I think it's an interesting thing. Like, so something that we've looked at is the rates of return on just like on LPing on Uniswap or SushiSwap or sort of one of these dexes. It's kind of, to me, the like rates of return to like LPing, let's call it USDC ETH or something like that, are just so like not even anywhere near like compensating you for the IL risk that you're taking, which like is like we've been looking into it like as a team, and it's like I don't know, it's just something it's kind of crazy. It feels like there's like 2 to 3x too much capital in these dexes given the amount of trading volume. And like it's funny because it's hard for me to understand like why there is so much capital in there, because like they're just taking so much IL risk. You know what I mean? Like it's just I don't know. It's just kind of like an interesting observation, and I guess like it's interesting because like I guess what you would expect normally would be that eventually sort of like the supply of capital in DeFi would just decrease, right? If there just isn't, if there aren't returns necessary to like justify capital, like, well, there should just be less capital, right? But like I don't know. I mean, it'll be interesting to see, I think, whether or not you see, a large scale like transfer of funds, um, out of DeFi and into CeFi. If rates continue to stay where they are now. So it's something that I think we'll be, keeping an eye on, because I think that's like a possible way that this actually balances out, is you just get money leaving the system. And we'll see.
Yeah, I mean, I think definitely in the case of AMMs, I mean, it's a little easier to explain for longer tail assets where the teams are typically providing a good chunk of that liquidity, right? Because they're not just optimizing for net yield, like they want people to be able to buy and sell their token at reasonable slippage. But that really doesn't explain why there's more liquidity than there should be for like a USDC ETH LP. I do think a lot of it is just like it used to be a lot more profitable to LP in those pools, and a lot of people just haven't moved their assets out. And you can see that with V1 to V2 like DeFi protocol migrations. I mean, there's just like absurdly shocking amount of capital that stays in the V1s of these protocols and eventually like earns nothing, and it just like takes forever. So I think I don't know, people have been busy managing their more risky, higher productive farms in the bull market, and now they'll go back to their USDC ETH LPs.
Right. I think you're right. It is always kind of remarkable how long it takes for people to like move their assets. It's not definitely not like a super professional user base that's like on top of it and doing everything on same day. Definitely not.
There's both though, right? I mean, it is it's harder to measure the profitability for like a more sophisticated market maker that's hedging their liquidity pool with like perps off chain, which like definitely happens quite a lot.
Yes. I think that's true. But I think that there's still like just like a ton of assets that's at least from what I can tell, like just like taking like a really bad risk reward proposition sitting in these AMMs. But that's, I don't know, just something that we've been looking at in the last couple of days.
Yeah, I mean, DeFi very much offers the opportunity for retail to make very, very granular investment decisions, like what pool are they going to market make on. But I think we'll see more abstraction of that, or DeFi native intermediation of folks who kind of help point investors in the right direction, and maybe we'll provide a means to get lower friction switching costs into CeFi yields if and when those are higher.
Yeah, cool. Sounds good to me.
Sweet.
All right. Well, let's wrap it up. Anything you want to show at the end, Nathan? Job openings, or where to follow you, or new products, or anything? Quick.
Yeah, I mean, always hiring. So jobs.ondo.finance for yeah, that's it for that. And then I guess just stay tuned for our Curve Vault launches pretty soon. And thanks for having me.
All right. Yeah. Thanks so much for coming on. We appreciate it.
Cool.
All right. Have a great one, everyone.
Bye, guys.